Hello, hello, hello. I'm gonna give it a few seconds because I always have to check this stream because I have it streaming from like several different live entertainment is back. Locations now. Casino Resort. Now is your time to see. Okay, sorry about that. So yeah, there's always something. So I'll let you go ahead and introduce yourself. You all know I've been talking about it all week leading up to today. I have a special guest today. Her name is Dr. Rosche, and she is a financial psychologist. So I'll kind of just let her explain to you what that means. And September is National Life Insurance Awareness Month. So obviously that's what we're going to be talking about. And she is the expert. So I'm going to let her go ahead and take it from here.
All right. Well, thank you, D Signs. Well, hello, everyone. I am excited to be here. Thank you once again for having me. My name is Dr. Rosche Brown. I am also known as the Doctor of Rethinking because I help people to remix their thinking so they can make money, manage money, and multiply their money. Okay. And so if you know that's something that you're excited about, I like to, if you catching this on the replay or live, that you say, oh yeah, I want to make some, I want to manage it better, and I also want to multiply it. And one great way to multiply your money is through life insurance. I feel like since the pandemic has started, there's been a lot of TikToks and a lot of, more like videos on Instagram about it. And so life insurance is a great way to multiply your money and really leverage it for generational wealth. And so we have a whole month dedicated. So September being like National Life Insurance Awareness Month, dedicated to help people understand it. Because the reason why we don't have it, I think, is because we don't understand it as much, right? And then give you a little bit more background. I am a financial psychologist. My doctorate degree is in psychology. So I'm actually a licensed clinical psychologist. I've been doing, therapy, depression, anxiety, ADHD, all that great stuff ever since 2006. So it's been a long time in that business. But about 7 years ago, I realized that finances were really like harming us, right? So, and we in our community ultimately is that people when they have mental health stress, they got financial stress. If it's financial stress, it'll impact your mental health, right? And so because I definitely started seeing that, I really got into the finances, helping people with their money mindset, and then also got licensed as a life insurance agent as well. So that's a little bit about me.
Okay, cool. So, we can just go ahead and dive right in. I've had, as I mentioned to you, I've had several conversations lately, and they've surrounded either, I guess we can kind of start at the number of people, shockingly to me, that don't have life insurance.
Yeah.
It comes up a lot with maybe the affordability aspect.
Mm-hmm.
And with that, the conversation comes up with the term life insurance versus whole versus the index, which I'm pretty into as well. So if you can kind of speak to that, because there's a lot of conversations surrounding the two, and I'm glad you mentioned the, or not just the two, because there's more than that. I'm glad you mentioned like the TikTok and the social media, because a lot of us are seeing like those little bursts of post, and they're kind of just quick bursts, but they don't really go into detail about what really, the mechanics behind everything is, so.
Yeah, definitely. So on one hand, so I think we don't have life insurance for multiple reasons, right? Honestly, one reason I think is really a big area of like just kind of ignorance, right? Like, how we're talking about literacy, financial literacy. A lot of us just don't even have an understanding of that, of what like life insurance is for. And then another thing that we tend to think is that life insurance is for when we are already close to already passing away, right? So we already are thinking about it. We don't start thinking about it until we're 50, 60 years old. Like we're already older. We're like, oh yeah, I should get some life insurance for my family. And not recognizing that the older we are, the more expensive life insurance actually is. And a lot of us don't know that. And so we don't see what the benefits are for us having life insurance when we're young. And I used to be in that same category, like, why do I need it while I'm young? So I think that is a huge area. Another thing is that a lot of people, and people have explained this, that they saw their grandmas or great grandmas, the insurance person used to come to their door. Actually, I used to see this too when I was younger as well. Like the insurance person used to knock on the door and, take her payment, make sure that she was good to go. And then what ended up happening for a lot of people, this wasn't my experience, but for a lot of people is that by the time that their grandparent needed the insurance had lapsed, or maybe they had what is a term policy, and I'll break those down. And maybe the term policy had expired. So you're like, I saw her like, paying for this insurance policy for years and years and years. Now that we actually need it, why isn't it there? Right. And so that will make people feel even more hesitant around, getting life insurance, of course. Right. And then, like, I think the third category I would say a reason is I just learned this statistic. So I did not know this initially, but maybe about a couple of months ago, that 8% of the financial industry is African American. Wow. Right? 8%. So then what does that mean? Right? So that means that, like, we just naturally, right? Like, have an affinity towards people who are more like us.
Right.
Right. So that means that if people who are not looking like me, need this service, I just so happen to not share it with them. Right. And maybe if I do share with them, maybe they don't believe me and don't trust me. Right. So it's that dynamic that's there. So we need more people in the financial industry so we can share it with more people that look, like us. As well, so I think that's like a huge thing. So it's like we're not getting the literacy that we need because nobody's really telling us about this. I see so many people, other professionals, and I even including myself. I got my doctorate degree when I was 25 years old, so I was making money.
Okay.
Yeah, I was making money early, but nobody taught me how to do anything with it. And the only thing I understood to do was save. Oh, I'm buying me a house. Like that was like all I think. I'm gonna buy me a house. That's all I cared about. But nobody introduced this to me. And so imagine somebody introducing that to me when I was 25, how much more money I would have had to leverage to do other things, right? It didn't get introduced to me until I was almost like maybe 31, 32, something like that, is when it got introduced to me. And so that's when I started to, utilize this. And I needed somebody to explain it to me in a way that I understood, because I still didn't understand. I didn't have no kids. So I was like, why do I need life insurance? You know what I'm saying? Like, I thought that's what you needed it for, right?
Right.
So nobody really gave that explanation. So I would say those are some of the reasons why people don't have it. And if you resonate with that, of course, put that in the comments. Like that you maybe resonate with, like, oh yeah, I didn't even think about it. And I just did a couple of interviews on Labor Day. I had like this big event. And on that event, one of the, it was a young couple, they're in their 20s, and they said, I thought that you just got life insurance when you start working. Like, I didn't even think about getting life insurance outside of work, right? And so if it was part of the benefit package, I just hoped it was there, and I just rocked with that.
Yeah, I talk to a lot of people now still that only have life insurance through their employer,
Yes.
And I was talking to my husband about that about a week ago. Unfortunately, I lost my mom last year, and going through that process, she had different policies, and one of her policies was through her employer. And we learned like that the funeral homes and stuff, they don't even take those policies, like the employer policies that like whatever, I forgot the technical term, but whatever they attach to it to pay whatever needs to be paid. They won't do it with employer policies. Only, she had another policy and that was fine that they used. But I was like, dang, so what if she only had the employer policy? Like we would have been, scrambling. You get that money, that money came later. I think like
you do still get it.
Yeah, you get it. But it was like the funeral homes was like, no, we don't, we can't use those policies. And I was like, dang, I never knew that.
Right.
So everybody out there is just like, oh, only have an employer policy and think that that's sufficient. It's not.
It's not. But I mean, and for a lot of reasons for that too, right? So for one thing, employer policies are group term policies. Okay. And usually the term is as long as you're at the job. Right. So as long as you're at the job, then that policy is like in effect. Once you leave that job, even just to get a better job somewhere else or to retire, there are times that is not portable. Right. So that's why you have to ask your employer, like, if I took this, can I take this policy with me? You think you have this $100,000, $500,000 policy. Can I take it with me when I leave this job? That's something that people don't even ask. Right. So we just assume that it's going to be okay. Right. And it's not necessarily okay. So that's one thing to think. So you have to ask, is it portable? Does it go with me? And then when it does, if it is portable, how much more is it going to cost?
Right.
Okay.
That's a good question.
That's the biggest thing, because when if you just think about a group, anything like, right, if you're buying something in bulk, right, a lot of times it can be a lot cheaper. right? Because everybody's going in on it, right? So that the employer is buying insurance for everybody, right?
Right.
So it's a different situation. So you may be paying $3, $4, maybe $10 a month, like, pretty much nothing for the policy. But if you start to take it as your own, like as an individual policy, at that point, that's when it's going to cost a lot more, right? So you'll be like, oh, I'm used to $10. Now it's already it's 200, 300. I wasn't expecting it to be that cost, right? So you just have to pay attention to that. And that's why I encourage people to also have, another insurance policy outside of their job. That just makes sense. And even if you think about how young you are, like I think for myself, I have never stayed at a job longer than 5 years. Right? Because it just being the millennial Gen X, generation, we don't stay at jobs. My mom stayed at her job for 41 years.
Right. Yeah, we don't do that no more.
We don't do that. You know what I'm saying? We don't stay at jobs like that.
Loyalty no more.
Yeah, like, none at all. None at all. And if the pandemic probably made it worse, right? Like just no loyalty. We see more money somewhere else, we going somewhere else.
Yeah, that's facts.
Yeah. So that's, or we learn, we can be entrepreneurs. I can make more money for myself, even more so. Now you leave all your benefits, right? To go to become an entrepreneur.
Take the chance. Yeah.
You take the chance on yourself, bet on yourself. So so that's some of that too. The employer. Yeah.
So if we can talk a little bit about the different types of insurance, because as I mentioned to you, a conversation came up, I think it was about a month ago, about term versus whole versus, I don't even think index was in that conversation, but they were talking about term and whole, and one being better than the other. And that's a conversation and almost like a battle that I hear all the time. Like, no, this one's better. No, this one's better. So it's like, okay. And I think it's important to have all the information on all the products and figure out, which works best for you. But I'm hearing a lot of like, no, don't get this one. That one's bad. I've even heard like, no, that's a scam, and words like that. So you can talk a little bit about that.
Definitely. So there are different types of life insurance, right? The one that we hear about a lot is the term and the whole. Those are the two main ones. But let's talk about the pros and cons of each. Okay. So term policy, the pro or the advantage of a term policy is that it's usually inexpensive. Okay. To give like some context around it, maybe you get a term policy for $1 million, and it may only be maybe $100 a month, maybe even $50 a month, right? So it's really inexpensive. You're like, oh, I can get so much more coverage for little to nothing. So that's why we would think to get the term policy. But the disadvantage of a term policy is that it expires. It expires, okay? So usually they go 10 years, 20 years, or 30 years. So you think about yourself at being 30 years old, let's say, right? If you had a 30-year, let's go the highest amount. Sometimes they go 35, but usually no more than 35. 30 years. So now you're 60 years old. At that point, if you have not used your policy, now understand what life insurance is. So using the policy, right, would mean to have to, be gone.
Right, yeah.
If you have not used the policy, you know what I mean, by 60 years old, then your policy has expired. Expired. So that means that you're 65, let's say, and something does, even 85, let's go a little bit longer, like later on in life, we thought that you had insurance, but now you don't have anything. And so then now maybe you learn, maybe at 60 somebody tells you like, oh, you don't have any more insurance, it's going to expire. So now you try to get insurance. Okay. There's a big difference between being 30 years old getting insurance and being 60 years old getting insurance.
Can I ask you a question right there? I'm sorry. Yeah. So if you're in that situation and you get close to your term expiring, is there an opportunity for like, oh, well, to pay more? Like, okay, it goes into this 30 years or whatever. And then at 30 years, like, okay, maybe they'll charge you more. It just expires and you just lose the whole thing.
So there is two different things can happen. So some term policy have the ability for conversion where it can convert into a permanent policy.
Got it.
But usually that's going to happen more like year 15. It's not going to happen when you're like at year like 27.
Got it.
Right. So that you could, convert it into a permanent policy and you ultimately would be paying more. Right. Just give some context around it. Cause I just did a term conversion, but there was a person I had who had a $200,000 policy. She's in her 50s and she was, I think, 50 years old at the time, and she was paying like $50 something for that $200,000 policy, like little to nothing.
Mhm.
We just did a conversion, and we only converted part of it, just 100,000 of it, and now she's paying an extra $150, something like that. So she's paying an extra $150. She can pay the extra so she can have that permanently for the rest of her life.
Got it.
Right. So you do have you can do a term conversion. Now, what will happen, and this is where things get tricky. And so when people say purchase term and like invest the rest, it's like a phrase that is sometimes utilized by some life insurance agents who only sell term. Okay. Who only sell term, right? So just be careful of people who only do something, right? So like I do all of them because I think that they all have their places. Okay. Right. But you have to think about, like, if you're only selling term, what does that mean? So a lot of times those policies, so if you ever heard anybody say that, I won't say a name, but if they said that, then I want you to look at your policy, because what gets tricky is they will often say it prints to age 95. So you're thinking it goes to age 95 because the printing goes to 95. Okay, it's very, very confusing.
Okay. Can you clarify that?
Yes.
What do you mean it prints?
So if we were to look at,
and I'm sorry if you can pause for a second. I just want to say, if anybody has any questions, it's on. Go ahead and drop them in the chat, and I'll read them as we go. But yeah, could you explain that, please?
Yes. And so that's why I say this is where things get like really tricky. Mm-hmm. So there is a number page on your insurance policy. Okay. There's just a page of that has a lot of numbers, and it says, like, your age, like you are, say you bought it at 30. So you'll say 30 and it'll go 31, 32, 33. And it'll basically say like how much you're going to pay every single year. So right next to it, it'll tell you your premium on that page. Okay. Mm-hmm. What'll happen is that page can print all the way until age 95. Mm-hmm. But let's go with that 30-year term concept, right? What you're going to see is this. So you'll be paying, let's say you're paying $100 a month. All right. You're paying $100 a month up until age 60. So you're used to $100 a month. Once it hits age 61, it's going to tell you how much it is going to cost if you would like to keep it. Right. So, you were saying, oh, can I just pay more and then I can keep the policy? Mm-hmm. Well, at that point, I mean, it's significant, very significant. You're used to $100 a month. That number can like jump to almost close to like $600 a month. $700 a month. And so you're going to be like, I don't want this anymore. Right. It's like significantly different. And then it's going to be, that's at age 61, $700. Then 62 is going to keep on going up, $800. And then 63, you see what I'm saying? It's going to keep on going, even though it's printing to age 95, right? You have to pay attention to how much it's costing until that point.
Got it.
So that's the trickery a little bit to me of that, because a lot of people will see the 95 and they'll think, hey,
I'm covered until then at that price. Okay, got it.
Exactly. And that's not the case. So you just have to be very careful to just pay attention. And so that's why, even for me, I even do like insurance reviews for people. So if you already have life insurance, you don't really understand it. You just got it because somebody told you to get it and you knew it was a good thing to get. Right.
Right.
But let's review it. Let's look at that number page and let me show you, right? Because it's about educating, so once you see it, you'll be like, I don't want that anymore. Right. And then you can now make a decision to say, I want to get something better for my family and where I am today.
Got it.
Okay. So that's the term. Any questions about term so far?
If you guys have any questions so far, please drop them in the chat.
Okay. And let me tell you, and just for me, the reason I do term policies as well, I do other ones, but the reason why you have a term policy is for things that are temporary. Okay. So let's give an example of, like, you get a home. So you become, you're a notary, right? So we understand, actually, matter of fact, for all notaries, right, that listen to this, you're, good notaries are doing home, like loans, right?
Right.
So when people are getting a home, and it's something even to ask your clients, right? Is it they get mortgage protection, and what mortgage protection is like getting a term insurance policy. So say we're in California, say you have a home, and the home is going to be like $1 million, but let's go with $500,000, right?
Right. Man,
let's think about this, right? We're here.
Let's pretend.
Let's pretend, yes. So say you have a $500,000 policy, right? Because you're getting it for 30 years because you have a 30-year fixed loan for 500,000, right? So it's temporary. And so if something was to happen to you on year 10, your family, like your husband and your children, will be able to pay for their home because they have the term policy, right? And you paid like, inexpensive for it. But let's say, by the time age 60 happens, you done already paid off the house. So it doesn't even matter. Like, we don't need that term to continue for life because we've covered the house. Does that make sense? Like, so it's for temporary things.
Got it.
Right. Or even maybe when your children are young, you may add a term policy, right? Because they're young, you're like, okay, anything can happen, and I want them to have the type of lifestyle that I would like them to have. So you may decide I want to have another $500,000 term policy just until my kids turn 25 and they can ultimately take care of themselves. Does that make sense?
Mm-hmm.
Okay. So those are some of the reasons why you may get a term. So there's nothing bad about term. It just shouldn't be the only policy that you have.
So let me ask you this: you as someone who sells different types of products, or are you ever in the mindset of like, so, okay, let me rephrase that. So basically, you're looking at each person's situation as a case by case. It's not like you're like, no, this one is better than this one. It's just case by case.
It depends. Yes, exactly. Case by case. So it depends on what the client's needs are.
Got it.
Right. And what the client's needs are. So it's like if you're able to afford a $500,000 insurance policy for yourself, well, I would say go ahead and get the $500,000 permanent policy. You know what I mean? It's going to last your whole entire life. It'll cover the home, but it also can give you some other benefits that we'll talk about with permanent policies.
Got it.
So, and then also I may talk to somebody who just can't afford a permanent policy right now.
Got it.
Right. So you're like, it's a different price. So I'd rather you have some insurance, but I would want you to be educated enough to say, I'm only going to do this for the next 3 to 5 years. But once my business start popping, I'm going to get me a permanent policy. Or once I get that good job, I'm going to get that permanent policy.
Mm-hmm. That makes sense.
Okay. Yeah. So it depends on the client. So that's the term. So real quick, pros, inexpensive, like cons is that it can expire. Okay. It will expire. Not can, will expire.
That's a fact, right? Okay.
That's a fact. Mm-hmm. So then after term, they came up with permanent policies. Okay. And there's different names for permanent policies. Okay. So the first one that we're more aware of is the whole life policy. Okay. So we think about whole life. Now a whole life policy, the good thing about it is that it's permanent, right? The pro of it is going to last your whole life. That's why it's called whole life. Okay. Another positive and pro or advantage of the whole life policy is that it has something that's called cash value. And cash value is like a savings component. Okay. So it's a savings component that's riding along with your life insurance policy. Okay. So those are two really good things about it, right? So it's permanent and it has cash value.
Can you answer this really quick? What do you say to the people that say that the investment component is not, basically you do better with a term and reinvesting the rest versus the investment component on a whole?
Yes. So let me give you the disadvantage of the whole, and then I'll tell you why that debate is out there. Okay. So with the whole life, with the whole life policy, the disadvantage of it is that it's very rigid, right? So if you have to pay $150 a month, if you don't pay it, it can lapse, right? Like very quickly. Okay. Mm-hmm. That's one disadvantage. But the other disadvantage is the savings component, that cash value. It's growing at 2 to 3%. Okay. 2 to 3%. Now this is why this is important. If you were to look at inflation right now, even I'll say like a couple months ago, let's say January, inflation was at 3 to 4% at that time.
Out of control. Yeah.
Okay. Inflation today is like 9%. So anywhere between 7 to 9%. Okay. So if we think about our money growing at 2 to 3%, right? That's not really like a huge amount of growth,
right?
With 2 to 3%. If you think about it, in comparison to looking at the stock market, if you were to invest in even they're called ETFs, like you could just pick at random. Ultimately, what they will say, like you could pick at random a couple of things that in the stock market. But let's say the S&P 500, something, that people are aware of, on an average within a 10-year time frame, it would give you a 7 to 10% return.
Okay.
Right? So if you just put that money in the stock market, you'll get 7 to 10%. That's the natural way of it, even though we have dips, right? So even though, of course, like 2008, we had the crash, right? And even though pandemic, we had a crash, in the overall like long-term 10-year gain, even 20-year gain, it's going to give you a 7 to possibly 10% return.
Got it.
Okay. So that's why, ultimately it's going to be better. So if we look at the difference between the term and a whole life, those are the comparisons, term and whole life, right? Not term and all permanence, but term and whole life. Those are, if we look at those comparisons, the example, like, so say you're paying, $100. I'm giving an example, $100 for $100 maybe for like $1 million term policy, right? So let's say that's what it is. If you were to get $1 million policy at 30, you may be paying like $400 a month, right? 100, 400. So big difference, right?
Right.
So now you're sitting there thinking like, well, because that is a $300 difference. What I could have done was get a term policy, put that extra 300 inside of the stock market, right? That's the idea. It would have made a 7 to 10% return. And then in 30 years, when that term policy expires, it's okay because I have $300 that has made 7 to 10% return within that 30 years.
Got it.
Does that make sense?
Yep.
Okay. So that is the thought process around it. Now, this is the problem with it. And what I've seen is that a lot of life insurance agents may tell you to get the term and they'll tell you to invest the rest. But you want to ask yourself the question, do you know how to invest?
Man.
Just think about, like, do you even, half of us don't even know how to even just even say, hit buy, right? You know what I'm saying? Like, we don't, we have no concept of investing. Mm-hmm. So what are the odds that, even just with managing money, if you had to say you have ability to pay $400 a month, that's not an issue. Financially, you can do $400 a month. That's not a problem for you. But if I told you to pay something $400 a month, like a life insurance, you would probably just pay it because it's just coming out of your account, drafting naturally.
Right.
Every single month you had to think about $300. Where should I put it?
Yeah.
How likely? Yeah. How likely are you to even do it? Most people have so much anxiety around money and numbers and everything. Mm-hmm. So the idea of being like, oh, what do I pick? And you had to think about that every single month.
Yeah, I would assume you would need counsel on that. You know what I mean? Exactly. You would need a professional to coach you on where to invest your money, because I wouldn't have a clue. And I've had term policies in the past, and I never, I knew that that's what I was supposed to do, but like you said, I was like, I don't know.
Who does it? That's the problem. Like you said, they sit there and tell you to do it, but a lot of them are not even licensed to do both parts. Okay. So some of them are able to license you the term insurance, but not to help you with the stock investing area. Mm-hmm. And then this is my personal ones that I've reviewed. I've seen that they have put people in investments, and the investments haven't done anything. Mm-hmm. You know what I mean? So
I was in that situation as well. Yeah. I did have one that was helping me, but it was like it didn't really do much. So yeah,
I think you could put your money in a savings account.
Yeah,
I could have just got a high yield savings account and did the same thing. Yeah. And my money wouldn't have been locked up, you know what I mean, somewhere else.
Exactly. So yeah.
You see? So that's that with that debate of term versus whole life. The concept is true, right? To technically, to buy a term and invest the rest. The concept is true. The problem is that we don't do it. Mm-hmm. Right? We don't do it. And we're not really encouraged to do the other part. We're only encouraged to do one part.
So what would you suggest for somebody who wants to go with term and wants to invest the rest? What would be your advice? Is that something that you offer? Do you have a resource or reference for them to get the proper information to make sure that they're investing properly?
So it's not. So I'm not licensed in technicality to be able to tell you where you're supposed to invest your stocks.
Got it.
Right. So even though I'm licensed in life insurance, I'm not able to tell you. But if we were to say, like, just in general, you could purchase Apple, right? You could purchase Google. You could just stay with something that is going to be great long term, right? You can just think about that, and you can say, hey, I'm about to put $300 in every single month, and I have it on a recurring investment. And it's something that's called dollar cost averaging. So maybe it's high this month, but I still put my $300 in. If it's low this month, I still put my $300 in, right? And you would, continue to do that over time, and that could be one way that you could do it. Okay. But to be totally honest with you, the market has been so funky just within the pandemic. It's been like, I do day trading, so I'm more aware of like how funky it's been, like, because I'm looking at the charts more frequently. But if we were to look at it, you'd be like, you might pay this month, for a stock, I don't know, maybe it was $2,000 last month, right? And then now it's like down, you know what I mean? Like, I don't know, $1,500, or it can be so big of a difference that it wouldn't even be the best financial advice for you to, or even, I don't want to give advice, I'm giving education, but but it wouldn't be the best thing for you to do is to just keep on putting the money in every single month, because it's been so up and down in the way that it's set up, right? And so, yeah. And so when we talk about like the other permanent policies, okay, and I'm just going to give you these other ones, and then I'm going to talk about the IUL, which is the one that most people like.
What up? He gave me a lot of cards. Pikachu.
I told you he was gonna make a.
We're gonna teach the children while they're young. Okay. Let me just give y'all this. TD Jake says, it's better to leave something in your children than something to your children.
Right.
Here's Pikachu.
Right. Because we have to be in a position where they have something in them, to like be able to handle the money that you might give them. Okay.
There it is.
So you start young. They got to be in the environment. Like, what's going on in Zoom? You got to just explain it to them, right? You buy them a life insurance policy, and developmentally, where are they at? You're like, hey, I love you so much. I'm already getting you and them together. Exactly. I wish somebody did this for me.
Exactly. Yeah, and I do try to take out the time to explain things to them as I'm doing it. You know what I mean? So they can kind of understand what's going on and why, and believe it or not, kids are so like those things stick. Like even at this age, like my son is 6 and I'll tell him things, and I've learned like don't dumb things down for your kids, explain it to them, and they get it.
They get it. It makes sense, right? And even just like the wealth formula is time plus money equals wealth, right? So the earlier that you start, you know what I'm saying, you can have little money, and he gonna be on a wealth game by the time he's 30. You know what I'm saying? Starting at age 6.
Yeah.
In comparison, right? Such ahead of the game, and his mindset gonna be ahead of the game.
Yeah.
So it's gonna be way better, like than the average 30-year-old at that time.
Exactly.
But so kind of moving to the other area of so we have the term, we have the whole life.
Right.
Then what they came up with was called a universal life. Okay. So universal life. And what a universal life does, positive of it is that it's permanent. It has the cash value. However, the premium is flexible. Okay. And what flexibility means that even if you're paying $150 a month, you have a minimum. So if you were in a financial hardship, you can say, hey, can you just bring me down to the minimum? Like maybe the minimum might be $75 a month. You go down to $75 a month. You also have ability to put more money inside the cash value. So that's the flexibility. You're like, oh, I could put more money in here. And the money's taxed differently. That's why you might do it. You're like, oh, cool, I'm putting more money in. So that's the flexibility of a universal life.
So putting more money in there will give you a tax benefit, because it's going to be taxed at a lower rate, or can you explain that?
Yeah. So another thing about the cash value of life insurance is the way in which it's getting taxed. Okay. So the money that you're paying towards your premium is considered after tax money. Okay. So it's going to grow, right? It's going to continue to grow. And when you decide to take that money out, because you can take the money from the cash value, right? Like when you want to, maybe it'll be for investing in property. Maybe it's for, maybe it's for your kid's college fund, or maybe it's for your retirement. It could be for different reasons. Right. But when you take that money out, you don't get taxed on it. There's no taxes. So let's say we see $100,000 in there. You can take $100,000 out free and clear. right?
So
With no taxes.
Yeah.
That's a big win, because let's think about your 401k, or maybe you have an IRA or a TSP at your job, or deferred comp, or whatever the case is. You take money from there, you're going to get taxed. So you might see $100,000, but you're going to get taxed on whatever taxes are at that particular time. Okay?
Yeah,
so it's not 100,000.
And I think I told you this, but I re-explain that to people I know, and they're like, "That doesn't sound right. That doesn't make sense." And I'm just like, maybe I'm not explaining it right. But yeah.
Well, okay. I mean, if you think, well, what people have to understand is that, and I think sometimes people need to see it, but this is the way that I normally explain it to people, and you can say this to them: if you had $25,000 and it grew to $250,000, which one would you prefer to be taxed on? The 25 or the 250? Okay.
Yeah.
And so people will be like, the 25. Most people are like, oh, the smaller number, right? If I'm gonna take 50% of your money, like if some people get scared about the fact that I even asked them a number, I'll be like, if I'm gonna take 50% of your money, which one you want me to take? 50% of 25,000 or 50% of 250? They're gonna be like, oh no, take that 25, right? So they're saying take the smaller number. So if you say that you want me to take taxes on the smaller number, well, let me explain your 401k. Your 401k says don't tax me now. Right? Don't tax me now on the 25, tax me later.
Got it.
On the 250. Right? And so then now people are like, oh, like, is that what that, because most people don't even realize that's what's happening.
Got
at
it.
that time.
So in the example that you're speaking of, we've already paid taxes on the money that we're paying our premium, paying to our premium. We've already been taxed on that. So it's not gonna get taxed on it again.
Exactly.
Even though it's growing.
Exactly.
Yeah, that's mind blowing.
You see, like that's how it works.
Yeah.
Right. So, I mean, that's why it's another great place, because you can have so much money growing and it's not even going to be taxed later on.
Yeah, that's
right.
Great.
That's huge. You know what I'm saying? And that's what kills, like when people are retired, what harms them the most is by the time you in your retirement age, you don't even have as many tax write-offs.
Yeah, true.
Right? Like, because your kids were your tax write-off now. Like, you got a 6-year-old, you write him off today. Right? But in 30 years from now, he'll be 36 years old. You can't write him off no more. Right. So that means that you have less of a write-offs. You, like, say you're in a home, right? You're in the same place. You're in a home, and 30 years from now, you did paid your house off. Right. What is that going to mean? You're going to end up, you don't have a mortgage interest as a write-off no more either.
Exactly.
So that's what we have to start thinking, like, okay, what's going to happen in the future when we're really thinking about retirement?
Right. So someone asks, are you borrowing the money you withdraw? Do you have to pay it back?
Yes. So when you're doing the cash value, the answer is not yes, but I guess I understand the question. Right. So when you get the cash value, you're not going to do withdrawal. You're going to take a loan. Okay. You're going to take a loan out on the policy, and you don't have to pay it back. And let me explain why. Okay. So what's going to end up happening? Let's say you have that $100,000 that's inside the cash value. You take a loan, and the loan is going to be like, they usually charge you about 5%. They're like at 4.55%. That's how much they're going to charge you. Okay. But the money is growing at 7 to 8%, sometimes even more. Okay. So imagine -5, +2, +7. That means you're still +2%. So you don't have to pay the money back. Just internally, it's going to get credited differently, right? It's like you're going to start just making 2% until it finally pays itself back, basically.
Oh, okay. Instead of the 7 to 10%.
Exactly. Yes.
Oh, wow.
Does that make sense? So you don't have to pay the actual money directly back. And if you were to pass away, let's say beforehand, let's say you took the $100,000 out, so you had a $500,000 policy, and you have $100,000 that's in the cash value. Say you pass away 2-3 years from at that point, and you clearly didn't pay the $100,000 back over time. They will just take it from your policy. So your family would only get $400,000 versus you getting $500. I mean, versus them getting $500. Does that make sense, Nina? I make sure.
Wow. Yeah. Does that makes sense to me? I don't know. Does that make sense to you, Nina? Let us know. Wow. Okay, that was a good question, and I didn't know that.
Yeah. So that's how it works. So you don't have to pay it back. And so then when you hear the concept of be your own bank, right? Because that was a huge thing, right? And like I even did a video on Waka Flocka, right? Like Waka Flocka was like, I put millions inside of my policy, you know, and all that.
We've all seen that video,
Yeah.
Mm-hmm.
And I mean, it's an amazing video. And I mean, I love the whole video of it because he talks about not being financially literate and getting financially literate, right?
Yeah.
Meaning that we can start one place, but we don't have to end there, right?
Yeah, I watched the whole thing too. Because sometimes, like I said earlier, those snippets is like they give such a very surface, and there's a lot more behind it. You know what I mean? But everybody be running with the snippets, and I'm like, wait a minute, you got to peel back the layers, you know?
Exactly.
Mm-hmm.
So, so when you think about the Waka Flocka example, I'll say of become your own bank, you can borrow from your cash value of your life insurance. Okay, so let's say even like 5 years from now, let's say you have like $60,000 in there. I was just doing an example with that. So it has $60,000. What you could do is you have the ability to go into your policy. I mean, say you buy a home. So I just invested in a property, just give you guys some understanding. I mean, I told you actually. Like, oh man, I forgot you could have done it. But I bought an investment property, and I'm in California, and so the investment property is not out here. But the property was $63,000. I bought a whole home for $63,000. I don't even understand the concept of being in Cali.
Definitely not around Cali.
Whole home, right? But what I ended up doing was putting $20,000 like down, and and I financed the rest. Okay, so let's think about that $20,000. I could have taken it from my life insurance policy, and now that $20,000 for me, I'm cash flowing about $500 or $600 a month. So now that $20,000 is making me $500-$600 a month. Like you can't put your $20,000 inside no savings account,
right?
You know, and make no $500 off of that money. So you see, like those are now you're starting to make wealth moves and more investing moves because now you have a big chunk of money that you can borrow from. You don't have to pay back. Mm-hmm. Right. You can make, if you make good moves, you can make money off of it. Right. Yeah. But even if we don't even say about making money, let's say your business goes down. Let's say you were a person who had life insurance prior to the pandemic, and the pandemic, changed your business. Well, you could have taken that money out, take $20,000-$30,000 out and lived off of it for a year. Yeah. Right. You would have options there.
Right.
So those are some of the things to think about when it comes down to your life insurance, policy. As many things you can do with it.
Right. Different vehicles. Okay. Yeah. Wow. That's amazing. I really appreciate you taking the time to break those three down because like I said earlier, there's so many different, so much commentary and sometimes confusion. So that was very helpful. Does anybody else have any questions? I also want you to drop your information in the chat. So if anybody needs to contact you, like we mentioned earlier, to kind of take a look at things on an individual basis, I want them to be able to contact you because as always, you just have such a wealth of information. I really appreciate this.
Yeah, no problem. I was like, I gotta figure out how to even drop my information in.
Can you drop it on your site?
Is it private chat? I don't think that's gonna work.
Can you see it? Can you see the chat?
I only see private chat. That's the only one I have options.
Okay, so so what is it? And I'll drop it in the chat.
Okay, they can go to rethinkinglifeinsurance.com and jump on you can jump on a call with me. It's free, right? So I just have to tell people like it's free. Because I think that it makes the spirit be like, I don't know. She probably costs like an arm and a leg, right?
Yeah, no.
But it's free. It's free. So
rethinkinglifeinsurance.com, right?
Yeah, rethinkinglifeinsurance.com. Okay. Yeah, there we go. And so when you actually go to that website, it's just going to allow you to just jump on a calendar with me. But like I said, it's free. We're going to just kind of think about what are your goals because I need to understand you a little bit about who are you? What do you need to do in the future? Are you looking for retirement? How do we get there? And then we'll look at your current policy. So if you already have an insurance policy, I'm going to review that. Let's look at the number part. What does it mean, right? What does the term mean versus not the term and the permanent? What type of policy do you have? Because a lot of people don't even know which one they have. So we'll kind of look at it and I'll give you some understanding about that. And then if I'm able to help you, right? And it doesn't mean that I'm able to serve everyone. The the call itself will be serving you. But like, I may not be able to get you a different life insurance policy. Maybe what you have already is already amazing. And I will let you tell you, I will tell you that, like, hey, you got a good policy. You got this when you're 25, you may not have understood it, but everything's going well.
Right.
But how do you now do more? How do you do more? Okay. Because a lot of times people don't leverage their life insurance as much. So giving you, I didn't go over the index universal life policy.
Okay, we can go over.
I forgot to tell you guys, but so that when you hear index, so INDEX, universal life, so it has all of the great benefits, all the other policies, right? So it's permanent. It has the cash value in it, and it has a flexibility there. Okay. However, the way that the money grows, now this is why most people don't compare a term against an IUL. They don't usually do that comparison. They do a term against a whole life. Okay. Mm-hmm. Now the way that the IUL works is this: it's following an index, and so depending on the company that you're in, the company may be like it might be S&P 500. It could be the NASDAQ. It could be the Dow. It could be gold. It's so many different ones. It just depends on the company. But if we think about the S&P 500 being the 500 top companies, right? What will end up happening is this: when the stock market goes up, right? Your money goes up. We like money going up,
right?
But let's say the stock market does 25% of return. You would only get 15. You won't get all the growth of the market, okay? But it's to account for when the market dips, because that's what markets do. When it dips, you don't lose any of your money. Okay? So when the market goes up, you're gaining, but when the market goes down, you don't lose.
So when it goes up, it's 25%. It's only going to go up 15 to account for that little buffer. I'm still on the call, but
exactly. And so it's important for you guys to kind of understand that idea, right? Because if you have a 401k, your 401k is just doing what the S&P 500 does. So the S&P does 25%, yay. But the next year, I mean, when we had the 2008 09 crash, it went down 39% in that year. 39%. So imagine you made 25 the first year, but then you went down 39% the next year. So now, say we had $100,000 and you lost 39,000 of it. Now you're at a place that you need to recover from the loss. You need to get to 100,000 again.
And you hear a lot of people saying that, like, "Oh, I got to recover from X, Y, and Z." Yeah.
Yeah. So you're recovering from the loss compared to if you have your life insurance, the IUL life insurance, the Index Universal Life, also known as IUL. When you have the IUL, what ends up happening is that when the market is going up, so the market went up, you got $100,000. When the market went down, you're still at $100,000.
Got it.
You're not recovering from the loss. So when the market decides to go back up again, you're not going from the loss trying to get to 100. You starting at 100.
Got it. Wow, that's powerful.
You see how that goes? So that's why, and the IUL is amazing, because what it has done over 10-year, 20-year look backs, and that's the only way, kind of like the history predicts the future kind of model, is that it does grow at usually 7 to maybe about anywhere between 6 and 15% is what normally can happen.
Got it.
Okay, for that. So you have to think about that 6 to 15%. That's doing amazing. So for people who are not going to be thinking about, let me think about Apple, Google, where I want to go, in my stocks.
Right.
Now you're able to passively, participate in the market without having to think about participating in the market.
Yeah, I love that.
You see what I'm saying? So that's an important thing. But what I was saying also is about where we fall off a little bit. So even though you get an IUL, that's amazing, right? You got that, but you can add more money to it. And that's the part that we often don't do. So let's say, you pay $200 a month and you're like, okay, that's affordable. Maybe $100 of that is going to the cash value, but you got big goals. You're like, I want to retire at 55, or, my baby's got to go to school in 20 years or whatever the case is. If you're thinking like that, then you might say how much can I put in per month, right? What is the max that I can do per year? And let's say your max is you could put $600 in a month. And you're like, oh, that's nothing. I could pay $600 a month.
Okay.
Right. So why not go ahead and put that extra 600 in there, because that's going to grow that cash value better.
Okay.
Because that 600
And
growing.
there are maximums.
Say it again.
There are maximums.
There are maximums.
Okay.
Yeah.
Okay.
Yeah. So the maximum, like, I mean, it depends on your policy. So we'd have to like look to see what your maximum is. Because the way that it's growing, like the IRS is not going to be letting you just be
right. They're going to be like, okay, now hold on
yeah,
now.
Yeah. You're like,
you're doing too much.
But the maxes are nice. I mean, they're still like easily like maybe 10,000 a year, or maybe they're even sometimes 20,000 a year. It just depends on your policy, you know. So you can do some amazing things with it. So imagine you putting in $1,000 a month because you have it, right? Like, you know, if you have an extra $2,000 a month, why not put 1,000 there? Because you don't want to put the whole 2,000 in, because it, you know, it's growing over time, and it's gonna kind of like be not locked up, but a little bit more locked up than putting in your savings, right?
Yeah.
So you just want to think about that. Hey, somebody said Dr. Rosche is in the house. Hey, you must know me. Hey.
So wow, that was a lot of great information. If anybody has any questions, go ahead and drop them in the chat. And then if not, we're gonna wrap up. This has been an amazing conversation, as I knew it would be. So thank you all. Oh, somebody said, let's see.
Oh, hey, Serena.
Thank you all for joining. And again, I'm gonna pop up your calendar here, rethinkinsurance.com. This has been super informative. And even though I know we had this conversation before, I even learned something new. Like I said, sometimes, I don't know, what was that, like a year ago or maybe
about a year or so.
I'm just like, people ask me questions, and I'm the type of person, I love to share information. So when I find something that's beneficial, I'm like telling everybody about it.
Yeah.
Sometimes when I tell people about it, they like, that don't sound right. So I'm like, just call her, because
right. Yeah. And you might as well, I mean, just like, just, you know, get on the calendar. Let's just say it's free for you to even just ask me questions, you know, like, you want to understand the policy that you already have. Right. Let me help you understand it. Let me tell you, like, it looks like you can put some more money in here. Let's go ahead and do that. Right. Yeah. You know, if you need an extra policy, you do need a term. I'm like, oh, well, you just purchased the house. Maybe you do need a term. Like, we can look and think about those kinds of things together, versus you being left with your limited level of thinking. Like, we only know what we know, right? We need somebody else to help us.
And there's so much we don't know, especially as the people, you know, we're a little behind. So just let's continue to get that information out there.
Yeah, definitely.
So if anybody
even put my number, sometimes if it's, sometimes people don't like to click on links, but you can also put my phone number, and they could just they could text life to it. Okay. But the number is 510 629 9362.
9362. And there will be people watching this on the replay as well.
Yeah, that's what I was thinking. So
510-629-9362. Right?
Yes. There we go.
Righty. So someone said, thank you, very informative. Appreciate your time. Thank you so much for joining. And anybody on the chat, I was just gonna say, just drop anywhere from 1 to 10 if this was super, super informative. Go ahead and rate us either 1 to 10. I'm gonna drop a 10 because I learned a lot. So hopefully you all did as well. Those of you joining us live, and then those of you who are joining us on the replay. All her contact information is in the chat. And thank you so much for giving me some of your time. This was super informative. I didn't know that September was life insurance.
Right. And that's what we have. We have a whole campaign called Stand Up for Life. And so that's why I'm wearing this shirt, Stand Up for Life, because we are really serious about, you know, making sure as many people, you know about this, you know, because a lot of people just don't know what they don't know.
I love it. That is facts. So thank you so much. You all make sure to contact Dr. Rosche to get your one-on-one. Is absolutely free. And everybody have an amazing evening, and I will see y'all next time. Peace out.
Bye.
Bye.